Hey, folks. Welcome back to Boss Economics World, where we slice through the economic nonsense like a hot knife through government red tape. I'm your host, the guy who calls it like it is, and boy, oh boy, do we have a doozy of a story today. Wall Street's throwing a summer party, popping champagne like it's 1999, while the economy's teetering on the edge of a cliff. And guess who's to blame? You got it, the clowns in Washington. So, grab your popcorn, folks, because we're diving headfirst into this economic circus, exposing the chaos, the hypocrisy, and the sheer incompetence of our so-called leaders. Let's get started. Ladies and gentlemen, welcome to the Wall Street Summer Bash of 2025, a spectacle of irrational exuberance that would make even Alan Greenspan blush. The S&P 500 is hitting record highs, junk bonds are soaring, Bitcoin's back above $100,000, and even Coinbase is popping like it's the crypto heyday of 2021. The financial media is calling it the best cross-asset advance in over a year, fueled by a so-called receding fear of a global trade war. Oh, how cute. But let's not kid ourselves, folks, this isn't a triumph of investor optimism, it's a textbook case of denial, delusion, and desperation, all wrapped up in a shiny bubble, ready to burst at the slightest pinprick. Now, I know what you're thinking, but boss, the markets are booming. Isn't that a good thing? Oh, my sweet, innocent viewers, let me break it down for you. This rally isn't built on fundamentals, it's built on FOMO, fear of missing out, and a dangerous dose of government-induced complacency. While Wall Street parties, Main Street is buckling under rising jobless claims, a cooling housing market, and a consumer spending slump that hasn't been this bad since the start of 2025. And who's pouring the champagne at this doomed shindig? None other than the White House and their buddies at the Federal Reserve, who've spent years propping up this house of cards with reckless policies and empty promises. Let's start with the surface-level nonsense and dig our way down to the rotten core of this economic dumpster fire. At first glance, the market rally looks like a victory lap for investors. The S&P 500 surged 3.4% in a single week, closing at a record high, while junk bonds, those risky investments that even your grandma's financial advisor would avoid, extended gains for a fifth straight week. Meanwhile, 10-year Treasury yields dropped 10 basis points, signaling a flight to safety, and Bitcoin's back above $100,000, because apparently, nothing screams economic stability like a speculative digital token. But here's the kicker, folks, this rally is happening despite a laundry list of red flags that should have investors running for the hills. Dig a little deeper, and the cracks start to show. Consumer sentiment might have hit a 4-month high in June 2025, according to Friday's report, but let's not pop the confetti just yet. Inflation expectations might be cooling, but at what cost? Consumer spending, the backbone of the U.S. economy, accounting for nearly 70% of GDP, tanked in May 2025 by the most since January. Purchases of new homes? Down by the most in almost 3 years. And don't even get me started on the labor market, recurring applications for unemployment benefits are at their highest level since 2021, a glaring neon sign that the job market is slowing down faster than a government worker on a Friday afternoon. Now, let's go deeper still, to the root of this economic insanity. Why is the economy flashing all these warning signs? Because of the government's sheer incompetence, that's why. Take the White House's latest stunt, for example, threatening to end negotiations with Canada over a digital services tax on June 27, 2025. Really, folks? At a time when global trade is already softening, you're picking a fight with one of our biggest trading partners over a tax on tech giants. This isn't leadership, it's economic vandalism. And let's not forget the return of Donald Trump to the White House, bringing with him a trade policy so erratic it's giving Fed Chair Jerome Powell sleepless nights. Powell himself admitted in congressional testimony this week that interest rates would probably be coming down already if not for the uncertainty around Trump's trade antics. Translation: the government's meddling is paralyzing the Fed, stoking inflation fears, and keeping borrowing costs higher than they should be, all while the economy slows. Bravo, Washington, you've outdone yourselves. Now, I know some of you Wall Street cheerleaders out there are thinking, oh, boss, you're just a worrywart. The economy's fine. Well, let me hit you with some cold, hard facts, courtesy of the latest data and expert analysis. JP Morgan Chase & Company, not exactly a bunch of tinfoil hat conspiracy theorists, puts the risk of a recession in 2025 at a whopping 40%. Why? Because of tariffs, weaker household spending, and falling business sentiment, all colliding like a perfect storm. And they're not alone. The International Monetary Fund, IMF, warned in its July 2025 World Economic Outlook that global growth is projected to slow to just 3.1% in the second half of 2025, down from 3.3% earlier in the year, citing, you guessed it, trade tensions and policy uncertainty. But wait, there's more. The National Association of Realtors reported that U.S. home sales in May 2025 dropped 7.8% year-over-year, the steepest decline since June 2022, as high interest rates and uncertainty around tariffs choke off demand. And let's talk about those jobless claims. The U.S. Department of Labor's latest figures show that continuing claims for unemployment benefits hit 1.85 million in June 2025, the highest since November 2021. Meanwhile, the Conference Board's leading economic index, a key predictor of recessions, has been declining for 3 straight months, signaling a contraction is likely within the next 6 months. Folks, this isn't a recovery, it's a slow-motion train wreck, and the government's at the controls, asleep at the wheel. Now, let's talk about the Federal Reserve, the poor sap stuck cleaning up Washington's mess. Fed Chair Jerome Powell and his team are in a no-win situation, thanks to the White House's trade policy chaos. Powell made it crystal clear in his congressional testimony this week, the Fed would love to cut interest rates to stimulate the economy, but they can't, because Trump's tariff threats are stoking inflation fears. And here's the kicker, the Fed's own projections, updated in June 2025, show they expect inflation to hover around 2.8% through the end of the year, well above their 2% target, largely due to potential tariff-driven price hikes. So, what does that mean for you, the average Joe or Jane? Higher borrowing costs, weaker job growth, and a housing market that's colder than a polar bear's toenails. And let's not forget the fiscal side of this disaster. The U.S. federal deficit is ballooning, folks. The Congressional Budget Office, CBO, projected in June 2025 that the deficit will hit $2.1 trillion by the end of the fiscal year, up from $1.7 trillion in 2024, thanks to a combination of tax cuts, increased defense spending, and, you guessed it, trade war fallout. This isn't just bad management, it's economic malpractice. The government's spending like a teenager with their first credit card, while simultaneously sabotaging the economy with trade threats and policy uncertainty. And who's going to pay the price when this bubble bursts? Not the Wall Street fat cats, it's you, the hard-working taxpayers, who'll be left holding the bag. Now, let's get back to Wall Street's summer bash. How can the markets be soaring while the economy's crumbling? Simple, folks, it's a bubble, fueled by irrational exuberance and government-enabled complacency. Raphael Thuan of Taikhaw Capital hit the nail on the head when he said, the market is exhibiting signs of complacency. Investors are pricing in optimistic outcomes across the board, ignoring the risks of trade wars, macroeconomic slowdowns, geopolitical tensions, fiscal deficits, and rising interest rates. And here's a fun fact for you, according to Barclays, quants and systematic investors are on their biggest buying spree since at least 2004, chasing trends across assets like lemmings running off a cliff. Volatility-controlled products are amping up exposure, retail traders are diving back in, and the S&P 500's valuations are stretched to levels not seen since the dot-com bubble, with a price-to-earnings ratio of 28 as of June 2025, per Bloomberg data. But here's the thing, folks, bubbles don't last forever. Julie Beal of Kayne Anderson Rudnick warned that FOMO isn't unbridled optimism, it's fear-driven, and she's spot on. The moment we get a whiff of bad news, weaker earnings, deteriorating employment data, or a full-blown trade war with Canada, this house of cards is coming down faster than a government budget proposal in a partisan Congress. And don't forget, traders are already loading up on protective options, with downside insurance demand spiking in funds like the ARK Innovation ETF and the iShares Russell 2000 ETF, according to Barclays. Translation, even the bulls are nervous, and when the bulls start hedging, you know the party's about to end. So, what's the takeaway here, folks? Wall Street might be throwing a summer bash, but it's Main Street that's going to wake up with the hangover. This market rally is a mirage, a champagne-fueled delusion propped up by government incompetence and Fed paralysis. The White House's trade threats, fiscal irresponsibility, and policy uncertainty are driving the economy to the brink, while the Fed's hands are tied, unable to cut rates without risking runaway inflation. And let's not forget the data, rising jobless claims, a cooling housing market, declining consumer spending, and a 40% recession risk, all screaming that a storm is coming. Here at Boss Economics World, we don't sugarcoat the truth, folks. The government's mismanagement is setting us up for a serious economic reckoning, and when the bubble bursts, it's not the Wall Street fat cats who'll suffer, it's you, the hard-working folks who just want a fair shot at the American dream. So, what can you do? Stay informed, hold your elected officials accountable, and don't fall for the Wall Street hype. Because if there's one thing we've learned, it's that when the music stops, it's always the little guy left without a chair. That's all for today, folks. If you liked this video, smash that like button, subscribe, and ring the bell for more no-nonsense economic takedowns. And remember, in a world of economic clowns, be the boss who sees through the circus. See you next time on Boss Economics World.